Misha Fomytskyi. He is the co-founder of Vola Dynamics. Misha, how are you doing?
Very good. How are you, Greg?
I'm doing great. Thank you so much. So I was thinking, we could start off by getting to know you, Misha. I know that you have a degree in physics and you worked at Getco and now you co-founded Vola Dynamics. How did you find your way into trading as sort of like a young man growing up?
I never imagined that I'm going to end up in finance. When I was a kid, I was fascinated about engineering and sciences. Then I went to a specialized school in Kiev, like school like 38 that has advanced programs in mathematics and computer science. So we did pretty sophisticated things already in high school. After that, I went from Ukraine to Russia, which is kind of interesting topic now. And I did my undergraduate in Moscow Institute of Physics and Technology. It's kind of a top engineering school, as a science and engineering school in the former Soviet Union, like right now in Russia. And at the time, this was like early 90s. The breakdown of the Soviet Union was not the most fun place. And well, it was a lot of fun, but it was not many opportunities and many students who wanted to do careers in something technical, something related to science, and they went abroad. And a lot of my classmates ended up at top universities, mostly in the United States, but actually some in UK and Germany, other countries. But mostly people immigrated to the United States. So I have a lot of classmates here. When I joined a Ph.D. program at University of Texas at Austin, I became like more interested initially like in computer science, but so there was a lot of kind of movement among physics PhDs, because you were thinking like, well, do you really want to become a professor? Do you want to teach, or you want to do industry? And then if industry, then what do you want to do? And some people moved to computer science, and I was kind of leaning there for some time. And then there were a lot of people who moved to finance, quantitative finance. I started taking classes in stochastic calculus, financial mathematics. And after my thesis, I interviewed a number of firms in New York, and I ended up at Wachovia Securities, which is currently part of Wells Fargo. The team that I joined is actually the founding team of Vola Dynamics.
Oh, that's fantastic.
Both of my partners, Tim and Yuri. So Tim was my first boss, and Yuri was like my. So Tim was Yuri was his first hire. I was his second hire. And then we went different ways. I went to trading. I first went to a hedge fund, traded volatility from the buy side perspective, and then I joined team one more time at Getco, where we did like high frequency options market making. After Getco merged with Knight, Getco first purchased Knight, and there were a lot of organizational restructuring. I left, and eventually we started Vola Dynamics with Tim.
Wow,
and Yuri.
That's fantastic. So before jumping into sort of Vola Dynamics, I just want to kind of stick around here and ask a couple more questions. So something that's really interested is you and your two co-founders. I think it's three of you guys, Tim, Jerry, and yourself. You guys all have PhDs in physics. Now, is that a coincidence, or is that's kind of what you need to do in order to make properly priced vol surfaces?
Yeah, this is actually interesting. When I did a lot of computational physics in plasmas, and when I came to Wall Street, I was surprised how similar the environment is. You still use C++, you still solve PDEs, you still have the same graphing tools. Well, you can think of Black-Scholes equation as a diffusion equation in different coordinates with just different boundary conditions. So it's very closely related to physics. And even like Fisher Black, he started in physics. A lot of prominent financial mathematicians actually came from physics. And Jim Gathrow, who's on the board, he's also like has physics background. So this is not a coincidence.
Wow.
Like a lot of like physics gives you like good training because you have pretty deep math understanding, but you also get training in experimental physics, how you go like from observation to formulating a theory and verifying that what you assumed is right, and how you quantitatively confirm it. And there's a lot of stuff like this you do in finance. Yeah, you start with option prices, and then like, what can you tell about this? What is consistent? What is not consistent? How can you calibrate this? What's kind of a good fit? Does the data match your assumptions? Like all those workflows are actually make physics very good training for quantitative finance professionals.
Well, that's super fascinating. And then something that's really cool about your background is you have experience as sort of a vol taker or a volatility trader from the buy side, and now sort of modeling the curves from, I guess, what market makers would use. So I guess we'll jump into Vola Dynamics. So my understanding of Vola Dynamics is if I'm a market maker, I'm creating markets around theoretical values. How do I know that my theoretical values are good? Well, there's a lot of models out there, and Vola Dynamics has sort of the most sophisticated model and the most appropriately priced model. So as a market maker, instead of coming up with my own theos, I can use Vola Dynamics, plug in Vola Dynamics theos, and to make markets around that. Is that kind of the right idea?
So let's take a step back.
Sure.
First, like Vola Dynamics has a very diverse set of clients. We have we have from ultra high frequency market makers, people who count like nanoseconds, to hedge funds that trade at very different time horizon, to banks that again like do like very different business, and some other firms that kind of pension funds and other entities, including crypto players. And the background of our founders is also kind of diverse. Yeah, we all kind of started at banks, and this gives you one perspective. First, if you work at a bank, one good thing starting at a bank is that you get a big picture perspective, because banks kind of sit at the center and they see everybody else. So you get kind of a better understanding of the landscape. And banks also trade very sophisticated products, like all kind of super exotic derivatives. And that's what was my starting point, where I had to build all this PD and Monte Carlo engines to price all kind of exotic derivatives under different stochastic volatility assumptions. Then I traded at a hedge fund side, so this is a completely different view on this. So if banks care about taking for there are a lot of different things that the banks do, but one kind of core problem is looking at the listed markets, calibrating a model that matches the listed market, and pricing more exotic derivatives with those models, and then hedging your risk and replicating whatever risk you can with what's available in the market in the more liquid products. So you charge the client some premium to trade what your client needs, like the risk exposure or whatever in whatever way it's more convenient for the client package the exposure, and then the banks hedge that exposure with and try to recycle the same risk with other clients. Whereas hedge funds have a very different perspective. They focus on forecasting, and they don't try to hedge or replicate. So hedge funds are the ones that don't hedge. So they figure out what they want to, what exposure they want to have, whatever they forecast, build positions, and usually sit and hold the risk. Well, this is a generalization. Nowadays, everybody may compete with everybody. Hedge funds competes with market makers and banks, and vice versa. But as a general rule, that's kind of the framework. Whereas like our high frequency market makers, they really want to match supply and demand very locally. They want to have like high turnover. They count the number of contracts that they trade and make certain small profit for each contract. They really don't care whether volatility is going to go up or down next year. That's not their business. And they don't care about the stochastic volatility model that you assume. But in each of these businesses, you have a common element. You need to describe listed markets in a robust way, that you have as little human intervention as possible, and that the vol surface that you get is consistent with distributions that it implies, that have realistic dynamics, and being able to describe the implied probabilities that are embedded in the listed market. So all of these players have to solve this problem, and you need to do it fast, and you need to do it in a robust way.
Yeah, that's fast.
That's kind of the core problem that our firm solves. Once you have that, then you can do other things that we also do, anything from volatility dynamics, P&L attribution,
that's fantastic. So
pricing volatility derivatives. We do a lot of other things, but the founding the core functionality is actually being able to very quickly and robustly describe the listed options market.
That's fantastic. So that's very interesting. So even though I'm a volatility taker, like my volatility model is super, important, or a buy side trader, I should say, my volatility model is super important. Even if I'm sort of a market maker, that obviously my volatility model is very important. So you described banks making exotic derivative markets and then hedging out on the listed market. So one of the things that, and feel free to jump in and correct me if I'm wrong, but one of the things that I know is kind of the first step to modeling sort of a vol curve is using splines. So splines are sort of the most basic way. For those who don't really know what that is, the way that I like to think about it is that if you need to trade a 5 delta option and you only have a 3 delta and a 7 delta, you can go ahead and interpolate with a model. And a linear interpolation is going to be too rigid. You can think of it as like half of a hexagon as opposed to half of a circle, where the spline will get you sort of that half circle because it captures that curvature. Now, Misha, why is a simple spline not good enough? Why do people need something more sophisticated than that?
Sure. So there are a couple of points here. If you have a fairly liquid market in a particular expiry, and you fit spline to it as a tool for interpolation, that works fine, like most of the time. It may adequately help you to average microstructure noise among different strikes and interpolate. However, if I'll give you a couple of problems that you will not be able to solve with just splines. So the first one is what if what if some part of the curve has incomplete or inconsistent market? If, for example, some strike range, all the offers disappear, or somebody places orders in the middle of the spread and you have not really consistent market. And fit to like a naive spline can produce very nonsensible distribution. It will be it may be very, very misleading because you don't have those constraints that will be given by the parametric curve. The second thing is extrapolation. So if you have some limited number of strikes and you want to go beyond this, for example, you want to price exotic derivatives that may depend on the behavior in the winds. How do you extrapolate? Like with a spline, you're going to get very noisy, sometimes they call it floppy tails. And many parametric feeders will have similar problem because you may be very sensitive to one or two quotes at the edges that and your extrapolation in the winds can be either produce arbitrage or create like very unrealistic probability distributions that would be not consistent with sensible dynamics. You're either going to get very steep tails and very close to arbitrage, or very low tails that you basically, well, you don't really going to price adequately the crash or surge risk.
Yeah.
One more thing is, how do you transfer information across different expiries? Say you have one term liquid, another term less liquid, and it has less data or maybe partially inconsistent, or you want to extrapolate, say you have the market up to 3 years and you want to go to like 5 years. What do you do in splines? It's very, like unless you have a parametric description of the curve with sensible parameters, so like all the curves that we have, the first parameter is always at the money forward vol, and the rest of the parameters that describe the shape. And these parameters are dimensionless, which makes it very easy to compare the parameters cross expiries. So you usually have very mild term structure cross expiries. So it's very easy to interpolate and extrapolate the volatilities, or correct if you don't have information in one term to determine one of the parameters, you can transfer the information across. And also compare the parameters cross names. Like if you have names with similar dynamics, like that behave similar, but may have different volatility level. Suppose you want to come up with a volatility surface for a new crypto asset that doesn't have listed options. How would you do this? So you can just look at the time series and see, like, does it have what's kind of the ratio of the volatilities? Is one of them more skewed than the other? And you can easily use this information to create a surface just from scratch from a volatility surface on an asset that does have options. So that's kind of pretty useful functionality.
That's fascinating. So real quick to touch on that. So let's say there's crypto assets that don't have option markets yet. I can go ahead and calibrate the realized volatility of this crypto asset to the Bitcoin realized volatility, check out the distribution of returns, see how they differ or where they're alike, and then basically look at the vol surface of Bitcoin, make adjustments, and basically now extrapolate a vol surface onto this altcoin. Is that pretty much the gist of it in a nutshell?
Yes, and that functionality definitely has been used for a long time, because in equities you always have new listings, you have either new expiries are listed, and you need, like, suppose you need to open the market when a new expiry is listed. How do you come up with a vol surface? Or you have a new name, and yeah, you need, suppose you are the first one to make, who needs to make a market on this name. So yes, that's kind of one way to do this.
That's fantastic. Now, there's some models, parameter models like Sabre, SVI. Can you briefly describe those and maybe talk about some of the shortcomings there that are well known without giving secret sauce that Vola Dynamics has developed over the years?
Yeah, sure. There are definitely several curves that are available in the public domain, and some of them are pretty good. Like, for example, SVI and SSVI, they have been used very extensively in the industry, and we still use them. All these curves are available in our infrastructure as well. We do not recommend Sabre curve because it has, if you go far in the winds, it creates arbitrage. But SVI and SSVI, those are very good curves, and they used, like SSVI we would recommend using it for the vast majority of the opera universe, and for any kind of less liquid, like if you start with, if you want to come up with a vol surface for a new crypto, that's probably where you would start. It's the simplest three-parameter curve that has very sensible asymptotics and details, and very intuitive parameters. So we use slightly different parameterization than was originally used by Jim Gathero. So it's the same functional form, but we write the equation in such a way that the parameters still have the same meaning, that the first parameter is the money vol, the second was normalized skew, and the third one is normalized curvature. So any asset would have very mild term structure of these parameters because they're dimensionless and normalized.
Fascinating. And so your team has a lot of experience in multiple asset classes. So you guys have experience in fixed income, FX, equity, and now crypto. What are some of the things that you've noticed between vol surfaces of different asset classes, or are they all the same?
That's an interesting question. So the way we think about volatility surface, you have three different ways to look at the market. You can look at option prices. You can look at volatility surface, or you can look at the probability density. And all of them are absolutely equivalent if you're talking about European options. So it's just change of variables to go from one to another. Once you have the density, you can calculate the price. If you have the price, you can calculate implied volatility. If you have implied volatility, you can always calculate prices, and from differentiation of the prices, you can calculate the density. So they are absolutely equivalent. So we think of a volatility, implied volatility, as the wrong number to plug in the wrong formula to get the correct price. That's kind of how you think about using Black-Scholes model in options trading in after 1987. So that's kind of very common approach. And as long as you have a volatility surface that is consistent with a realistic density. So yeah, so basically a volatility surface has to describe some density, and it will usually be fat-tailed, and it just happens that the tail behavior of most assets has particular asymptotics that's kind of similar to rebounds. At least this is what the market. At least this is what the market is assuming. So you have like fat tails, but not as fat to create arbitrage. That's kind of one way to think about this.
That's fascinating.
It may be a self-fulfilling prophecy, but that's kind of what the markets are doing.
Very cool. So, just a couple of quick questions before we move on to some more personal things, and we wrap up the podcast. One quick question is, in traditional finance, when you're talking about market making for sort of equities or Delta One products, speed is really a big deal. When you're market making for volatility, what would you say is like more important, a properly priced model or being fast? And is there sort of a give and take? If you have a property price model, can you be slow? If you have a bad model, do you need to be the fastest, or does that not relate to each other?
Being fast is important, but we need to separate what does it mean to be fast. Like, for example, if you're trading U.S. markets, your fast path, once you receive a quote, is you need to make decisions somewhere in the sub-microsecond time scale. Definitely, you cannot do a fit at the time scale, but the volatilities do not move at such speeds. This underlying market moves at such speed, but not the volatility markets. Volatility markets move somewhere of the order of seconds. Again, like, it depends whether this is a super liquid name or less liquid name. For less liquid name, it's moving even slower. It will take more time to move by the amount that is comparable to your spreads. At least that's what it means. But speed is still important because you have almost like 2 million options listed in the US, and if you want to even price all of them, so you need to start with those prices, and then you need to calculate implied volatilities, and you need to feed those volatilities to smooth surfaces, and then you need to price from that vol surface, and then you need to calculate the Greeks probably. That's kind of the minimum problem, and that's a lot of computation.
Mm-hmm.
And you need to do it fairly efficient. You don't need to do it at the scale. You will be doing it at the time scales of seconds, tens of seconds, or sometimes fractions of a second. But you still need to be able to do it fairly fast. Speed actually matters. Again, like, you can always say, we can use more hardware, but you always somebody will always have to price SPX, which has something of the order of 25,000 options, and over 40 expiries. Doing those fits, it takes time. You need to have pretty efficient algorithms and robust algorithms, because you're going to have a sequence of very liquid expiries, and the liquid expiries may not be consistent with everything else. So if you really want an arbitrage-free vol surface, every single time you do a fit, you need fast and robust algorithms. That's what we do.
That's super interesting. Okay, cool. And then last questions before we jump on to some more personal stuff. So if you were to kind of guesstimate, let's just start with equities, and maybe we'll go to crypto vol. What percentage do you think of market participants are using sort of old, outdated models versus what percentage do you think are using appropriate price models? And maybe this differs for equities versus crypto vol versus FX vol. And I know this is kind of an abstract question and it's just a guess, but I'm curious on your thoughts.
I don't think it's possible to answer this question because I believe like everybody is using the tools that are appropriate to what they're doing.
I see.
They either come out, like, if that's kind of a business requirement to do it at a high level, then people will do it at a high level. If, like, say, if you sell covered calls, well, you don't really need like a super duper fast volatility fitter and robust spot vol dynamics and all these bells and whistles, right? But if you trade large notionals on either at a high frequency, you're kind of a major market maker, you will have to come up with some combination of solutions that give you the robustness that you need.
That's fascinating.
Everybody who does that high level stuff, that they find a way to solve both speed and robustness. Sometimes people use it by utilizing more manpower. But again, it has some advantages and some disadvantages. Like, for example, many firms have individual traders managing the shape of the vol surfaces. They fit kind of a vol level, but the shape is managed by humans. They kind of do manual fits and they hold it. It gives you stability. It doesn't give you ability to adjust to the market when it moves, but it gives you a way to maybe the traders have some external knowledge about, they can develop some intuition why the market may or may not move in particular environment that will not be available at the. So there is a trade-off. There was definitely a trade-off.
Yeah, that's fascinating.
But again, in any case, I would say even if you want to do like manual overrides and express like discretionary opinions about the market, it's always helpful to have a tool that describes you the market as is very fast and very in a robust way that you can always know what the market is thinking.
Yeah, that's fascinating. And that's a great point. As you said, like everyone's got the tools for what they're doing in the market. And I guess, that's why we have a market. People are buying and selling for various different reasons. And that's why there's liquidity to be found. If everyone was doing the same thing, we would just be gapping up and down probably. So fascinating. So now kind of closing up here, you have an options trading career as well as a quant career and then a modeling career, and now you're a co-founder. Those are a lot of kind of very high level jobs, and they're kind of 24/7 jobs. How do you find time to do things for yourself, and do you have a family or any hobbies that you like to do on your off time?
Yeah, definitely. I have a family. Have a 10-year-old son. And I'm interested in other things. For example, I do contact karate. That's something that is helping me with having some rhythm that stabilizes your mental state. You meditate, you practice, you do katas, you break boards, you sometimes fight, and then you bow again and meditate and clean the floor and go back to your stuff. So it's like I've been doing this for a long time, and that's something that find very fulfilling too.
Oh, that's great. That's great. And then last question here. If someone wants, there's two more questions. If someone wants to read and get into, volatility surface dynamics and modeling, is there a good place to start? Is there any books you recommend? Is there any white papers that maybe you guys publish?
There's a lot of stuff on our website. We have a research section. It has presentations and papers, but that may be a little bit advanced if you are just starting. But there's a lot of material if you want to start in quantitative finance. I would definitely recommend to take some, it depends on what exactly you want to do. So right now, there's a lot of enthusiasm on machine learning. Everybody wants to apply machine learning to everything. That's definitely very promising. There are a lot of promising approaches, and people do apply this to solving a number of problems that were challenging before. But there's a lot of traditional math that is also still used and very relevant, like everything from probability and statistics. There's all this financial mathematics, Black-Scholes, and all the extensions of this framework, stochastic volatility models. So I would definitely, anybody who's interested in volatility topics, I would recommend Jim Gathel's book, Volatility Surface. And there are a number of other books on.
Cool.
If somebody is interested, you can send me an email, and depending on what one is specifically interested, I can, because it's a very big area.
Yeah.
It's like in what we do, you need to be fairly good at math. You need to be a very good programmer, and you need to understand the market. And
yeah, that makes a lot.
And know specific models, specific methods that are used here. On this note, by the way, we're hiring, and definitely Vola Dynamics is a great place for anybody who wants to do quantitative finance. From junior to more senior people, we have positions.
That's fantastic. So, kind of closing up here, if I want to be a customer of Vola Dynamics, or I want to learn more, or I'm a young quant who wants to work at Vola Dynamics, what is the best way to get in touch with you guys? Is it via your website? Is there an email? Are you guys on Twitter? Kind of what are the avenues?
Well, the best place to start is our website, and we have our email address there, info@voladynamics.com. You can find it on the website. And we have a lot of information, examples, description of at least some of the things that we do, because our list is expanding very rapidly in terms of what we offer. It's a never-ending development.
Fantastic. Well, Misha, thank you so much for coming on the podcast. I think this was a really good podcast with a lot of good information. And everyone who tuned in, thank you so much for tuning in. And remember, find edge, capture alpha, and slang size. Thank you so much.